So I'm pretty excited. I am going to start this portfolio today, even though I am jumping the gun a little bit. It's December 30th, but it's actually a good day to start because the market is down a bit today after being down a bit on Friday. And a lot of people would say like you wouldn't like if the market is on its way down, isn't it better to like wait till it finishes going down and then you can get in before it starts going up? But it's like, can you? Like, do we know when it's going to start going up? So, like, after it went down a little bit on Friday, maybe today it was going to go up, but it didn't. And it's like I'm not in the business of predicting what's going to happen in the future, and it's better for me to get in while the market is down or after it's gone down. And honestly, it's not down. It feels like it's gone down. It's gone down 1% today and 1% on Friday. But that's after it went up last week after going down. This is a 4% drop. Um, but in the grander scheme of things, if you zoom out a little bit, really the amount of red is really just a blip on the horizon. And this is the last year and a half chart. So really, we're at all-time highs, market highs. And especially if we zoom out one more, you can see that really we're absolutely at all-time highs. And the tiny bit of red that we see, that we feel now, is really nothing. Um, so for me, it's a good time to start the portfolio um, because the market is slightly down. But yeah, and I had a bit of time to do it. Um, and I talked about Uh, and I talked about this new portfolio. It's going to be $100,000 portfolio. I made a blog post. It's actually not live. This is a preview. I mean, it's not going to be published tomorrow. But basically, it's $100,000 portfolios, and we can look at this $100,000 portfolio as 10 investment blocks of 10,000 each. So if I can find 10 companies that I want to invest 10,000 in, that will fill the portfolio. Um, and then basically in this portfolio, basically in general, I aim for 10% annual returns and not more. Um, that's not to say I don't ever make more, um, but that's what I aim for, and that's exactly what gives me the flexibility, especially when we're at market high, when we're at market tops or market all-time highs, um, as we are now. When you look at the bigger chart, um, then I definitely want to be very conservative in this. And then in the post, I put a little bit about dollar cost averaging. And I recommend you read this post before you watch this video or after or whatever, especially if you don't know what dollar cost averaging is. But basically, the idea is that instead of investing everything right now, like the whole $100,000 of the portfolio, I want a dollar cost average in over the next period of time. So by investing a certain amount every week, every month, every quarter, every whatever, and you can decide what it is. That way, if the market goes up or down, you get a better entry. So the investing rate. So for the investing rate, so I want to set myself up to make, and I detail this out in the blog. But basically, I want a dollar cost average in. So I'm thinking something about investing something like if I invest 12.5K every quarter, that'll be 50K per year, which means over 2 years, I will invest the whole portfolio of 100,000. So for 12.5K every quarter, which means it means just about a rate of $4,000 every month to invest. And that's slightly flexible. It doesn't have to be exactly $1,000 a week or 4,000 a month, but that's the general goal that I'm trying to aim for, is 12.5K every quarter. So right now, just to start off the portfolio, I can do slightly more, slightly less. But I want to aim for just about, so investing, let's say just about 4,000 right now. Um, and then I'd like to, and the strategies that I'll use are super simple, low maintenance option strategies for opening positions. It'll be short puts, so it'll be naked puts. And if you don't know about puts or what puts are, I actually did a video of it. It's on my website under the home page. It talks about, it's under the how does it work. It's on YouTube. It's a half an hour video. It's super down to earth. It explains stock options, specifically puts, as if you were in high school. So literally, it's the clearest, simplest way to explain stock options and specifically the relevant stock options for us at this stage, which are puts. Um, I highly recommend if you don't know what they are to check the video out. And I'm going to assume that you know what puts are for the rest of this webinar, and I'll explain them maybe for a split second while I make the trades. Um, but but really, if you don't know what they are in the middle of the night, if I were to wake you up from a deep sleep, I highly recommend you watch this video just to have it locked in your mind. Um, so then the question remains is what companies we want to invest in. And I'm a tech. I believe in tech. I think tech is growing and it's going to continue growing, and that's going to be a market leader in general. And tech has some mega cap. The biggest companies in the world are tech companies. So like one of the four of the biggest ones are obviously Apple, Amazon, Facebook, and Google and Facebook. Um, I want to choose one or a couple of them to invest in right now. So you got Apple. Apple is so this is the last year. This is the better part of a year graph of Apple. It went up from around 170 to 250, so it went up a lot, and that makes sense. All of these companies are going to be at all-time highs because the market is at all-time highs. So Apple specifically has pulled back from 260 to 253, which is very, very little, but it has pulled back a tiny bit. Let's check some other ones. So um, Amazon is at 220. It's also pulled back slightly from 230 to 222, so it's still basically nothing, but it's still basically at all-time highs. And this graph looks slightly less steep, but it has gone up from 160 to 230. And then we got Facebook, which is Meta. And then, so Meta is it's a $600 stock, so it's slightly more expensive. That doesn't mean the market cap is bigger, but just the stock itself is more expensive. And it's actually again, close to all-time highs. It has a little bit of support here at 600, but it's down from 630, but still very little. And then the last one, Google. So the last one is Google, and Google also is at all-time highs. It's pulled back a little bit from 200 towards 190, but still it's at all-time highs. So let's start with, I think I like this graph of Google because Google has pulled back a little bit in the last month and whatever, I don't know, Google, AI, all that stuff. I think it's going to be good. The market cap is massive. It's 2.3 trillion. Um, but let's open a position. I think we'll open a position in Google and Apple. And again, I open positions that I believe in time in the market, not timing the market. And I also believe in having probability on my side. So when I say I want to invest in Google, it doesn't mean that I think Google is going to go up. It just means that I want to open a position in Google that sells time and that over time I'll make money, whether Google, even if Google doesn't go up, as long as Google stays the same or goes up or potentially goes down slightly, I want to make money in Google. So let's see what I can do. So I can sell a put in Google. So let's first of all, let's try to open a trade. Um, and let's say we want to search for Google. And what I'm going to want to do is I'm going to want to sell a put. And then I can sell either a 1 year put or a 2 year put. Um, but let's look what we can get. So Google, just from looking at the graph, if I can get in for 150 historically, and this is the daily graph chart. So this is the last year of Google. And then this is the weekly chart of Google. So this is the last 3 years of Google. So Google, I mean, obviously I won't get much money for selling a put at $100 for Google. And we can just look at that just to make sure. So a 1 year out option on put option on Google will give me $1. So that's peanuts. It'll give me $100. I'm not here to make $100. I want to try to make $1,000 over the next year or over the next 2 years, something like that, something around $1,000. So looking back at the graph again, obviously, I mean, Google's trading at $200. It doesn't seem realistic for me to be able to buy it for 100, but it does seem realistic. Maybe I can buy it for something around 160, maybe 150, 160, and then, or maybe if not that, then hopefully at least maybe 170, 180. So let's see what people are willing to give me for, let's say, 150. So for a short 150 put, someone will give me $6, 590, $6. Um, and then we can look at the probability. So the probability of maximum profit, maximum profit is the initial credit. So it's a $600 credit, 590, and the market gives me an 82% probability of maximum profit and an 86% probability of any profit, where the break even is Google is above 144. So if we look at Google, it would mean as long as Google stays above this level, as long as it doesn't drop back to where it was somewhere in February, March 2024, we'll make money. And if it does drop below that, then I get the option to buy Google for 140. And considering a year earlier it was at 190, 140 seems like a good entry point. So I would be happy to buy Google for 140. Um, But so this is a 1 year option. We can also sell a 2 year option and see how much someone will give us for that. So someone will give us $10, so slightly less than twice what they'll give me for 1 year, which makes sense because over time there's a slight decay in time. But someone will give me $1,000 for this for 150. So let's sell this option. And the way this works is I can't get the midpoint. Hopefully, I can get something close to the bid. So I can sell one put, and let's see what that's going to cost me in margin. So I have $100,000 cash value right now, and that's going to cost me. So I'm going to have cash buying power of 97.7. So it's going to cost me 2,000, just about 2,250 in margin buying power. So it's a very efficient, it's a very margin efficient play position. So it's going to cost me. So my best case is making $1,000, and that's costing me $22,000 in margin requirement. So basically, my return is kind of like 1,000 divided by 2,000 over 2 years. So it's close to 50% over 2 years just on the margin requirement. And obviously, that's not of my portfolio. My portfolio is still $100,000, but on this position itself, it's basically a return of 50%, which is or 40%, which is pretty nice. So let's try to see if we can get that to fill. Yeah, and I don't think we're going to be able to get it for that. Let's try to get it for 1,000. Yeah. So we got short puts for 1,000, for 1,050 dollars, $150 puts. And then so over the next 2 years, assuming Google stays above 150, these puts will expire worthless. I'll be able to keep the $1,000. And then $1,000 is 1%. So $1,000 is 1% of my $100,000 portfolio. So it's 1% over 2 years. So really, based on this position, I'm only making 0.5% a year on this position. So it's not very much, needless to say. But let's do another one. So we can at least let's get another $1,000 from a different company. So I want to try doing Apple. Let's try to sell a put position on Apple. And I already know I'm going to want to sell a 1 year position or a 2 year position, most likely a 2 year position. But let's just check them to make sure, and then let's look at the graph of Apple to see what Apple did and what we can get. So this is the 2 year, this is the 3 year graph of Apple. This is the shorter term graph of Apple, and then here it seems like around 200 it had support. So when it went above 200 and then it went down to 200, it kind of bounced off of that and went back up. So 200 seems like it could be a good strike price to sell. So if I promise to sell Apple, if I promise to buy Apple for $200, considering Apple is trading at 250, so we're 40% below what it's currently trading at, someone will give us $5, $6, just $570 for a 1 year option. And for 2 years, someone will give us exactly 1,000. So this is good. I like this. Maybe we won't be able to get 1,000. We'll be able to get 980. Let's see if we'll get 990. And we can sell one put, and then let's just see. So analysis is saying the stock market is giving me an 82% chance of maximum profit. So that's good. If you talk about like being the house, not the gambler, a casino has sometimes a 55%, sometimes a 60, whatever. Either way, only slightly more than half chance of making money. And casinos make massive money over the long term and over many people. So I'm taking an 82% probability of making my max profit. And then as far as what that's going to cost me in margin, so right now my margin requirement is 97 and this is 94.7. So this is another $3,000 in margin. And this is a 2 year position. So it's we're going to make $1,000 basically over the next 2 years. So it's a 33% return just on the margin requirement. So it's 33% over 2 years, which is 50% over 1 year. And that's this position. So let's see if we can get this to fill. We probably can't. It probably only gives me it really only gives me the bid. It lets me fill out the bid. So let's get that. Okay, and that failed. Okay, so now we have two positions. We have overall they cost us they were a net credit of $1,988. So almost, we'll call it 2,000 just for round numbers, because I like round numbers. And then these are going to expire over the next 2 years, setting us up to make $2,000 over the next 2 years, or $1,000 over the next year. So a return of 1% on my $100,000 portfolio. just based on these two positions. And these two positions are both super, super, super high probability positions of expiring worthless. And I'm going to leave it at that for today because, like I said, I want a dollar cost average in. Okay, and considering the market is at all time highs, I do see a potential situation where the market could correct down. It could at least 5 or 10%. Um, who knows? Because why not? It could happen. So I do want to make sure that I have plenty of room. So if Apple does drop down to $200, so if the market goes down 20% in the next 3 months, I do want to be able to double down on this and add more, sell more options and sell more time premium. Um, so what I'm going to do, so overall, I just invested, I started with $100,000. I now have $94,600 cash buying power. So I've used $5,500 of my cash buying power in this trading session. And I said that I wanted to, so my investing rate, I want to invest around 12,500 every quarter, which is around $4,000 every month. So this basically, so for the first month, this is really boring. But good investing should be boring. It shouldn't be exciting. I'm not looking to waste a lot of time checking in on my portfolio and buying and selling and paying fees and all this stuff. I want to have boring, low maintenance portfolios, which will consistently make me money, whether the market goes up, sideways, or even slightly down. If the market goes down a lot, like we're talking about a 10% correction, a 20% correction, a 30% correction, something like what happened in, let's say, on the NASDAQ in, let's say, 2022. So let's just zoom out on this graph. So in 2022, the Nasdaq started at 16,000 and ended at 10,500. So this is a 30% correction. It went down. It went down $6,000 on a 16. It's more. It's a 40% correction. It went $6,000 on a $16,000 stock or whatever index. So this stuff does happen. So right now we're up here, and I don't know. The market could continue going up like it has been going over the last 2 years, but it could also go down. So I want to make sure that if the market does go down, I have plenty of money to double down. Because that's the thing. If I invested all my money here and the market went down, yeah, a year later it went up and I would have made been broken even or made money if I had sold options. But if I had added more and added more and added more on the way down and lowered my cost basis, as soon as I got to here, I would have already made money, and here I would have made even more and more and more and more. So instead of breaking even 2 years later in 2024, I would have broken even way earlier, and then I would have made more money on the way up. So really, the secret to making better, the situation where I will make better than 10% returns is if the market does go down significantly, and then I'm able to double down and raise my investment allocation and be more fully invested to take more advantage more of the lower prices of whatever it is that I'm buying and the higher volatility. Um, and then wait for the market to go back up. Because wherever I invest, if the market goes down, if the market ever goes back to where it was, time has gone by. So I will have made money. So like if I had bought stocks, if it was January 2022, if this was the present and I had bought stocks, I lost money all through 2022 and then all through 2023. I still basically only made back some lost money, assuming I just held and I didn't sell when I lost money. Um, and then in January 24, I had basically broken even. But if instead of buying stocks, I had sold options, as soon as I got back to here, the options that I had have exactly expired. So whatever initial profit, whatever initial credit I got for these options here, it expired worthless in 2024. So instead of being even 2 years later and just having wasted 2 years of my life, when you sell time, time only goes forward. So if I had sold time in 2022, in 2024, the time had all expired. And even though the market was at the same price that it was back when I started, the 2 years had gone by and all my positions expired worthless. So in this case, I would have made, if I only had two positions, then I would have made the $2,000. But because I'm investing at a rate of $4,000 every month or $12,000 every quarter over for the 4 quarters that happened in 2022, I would have invested, and I would have invested $50,000 at an average of halfway between these, so $13,000. And then over the next 4 quarters, I would have invested another $50,000. So overall, my average would be just about around $13,000. Add to that selling the premium of the time premium, I would have done pretty well. Whereas if I had just sold the the options here, all $100,000 worth of the portfolio, again, it ended up that I would have made money anyways, but I would have made less money because my entry point, my cost basis was basically at 16,000, whereas if I had scaled in, my cost basis would have been at 13,000, so halfway between 16,000 and 10,000. Um, so this is it for today. And the market also is going to close in another 10 minutes. But yeah, but I just want to show, the margin requirement on this position is 4,000, the margin requirement on this is 3,300. And I have a net credit of $2,000 basically. So I'm setting myself up to make $1,000 per year over the next 2 years. And then over the next month, so this is basically enough for a month because we wanted to invest 4,000 and really I've invested like 7,000. I'm gonna, first of all, I'm gonna track the value of this portfolio over time. And again, over at the beginning, there could be some volatility in this, and I won't necessarily do better than the market if the market goes down. But over time, as the time premium is gonna decay, hopefully we'll see that these positions and this portfolio in general um, outperforms the market. And even if it doesn't outperform the market, I don't try to, if it's a very, very good market, so if the market goes up another 30% in the next year, because in the past, so for every year for the past 2 years, the market has gone up 40%, which is extremely unusual. Needless to say, the market usually goes up 10%, but I'm not looking to outperform the market when the market goes up 30%. I'm happy making 10% even if the market goes up 30%, as long as when the market goes down 30%, I don't lose 30%. So this strategy is it puts in a priority capital preservation compared to chasing outsized returns. And 10% is enough to double your money every, I think it's 7 years. So that's what I'm aiming for. And then if the market does go down, that's when I will double down and employ other strategies, which will leverage my money higher, and I can potentially make more money in those situations. But when we're at market highs, I definitely want to be very, very conservative with my investment, with my portfolio, because, like I said, most important for me is capital preservation. I'm not looking to try to get to $150,000 in the next 3 days or 3 weeks or 3 months. I would much rather not lose $50,000 in the next 3 months, because if I lose $50,000, in order to get back to 100, I have to make 100%. Whereas if I make 10% and then another 10% and another 10% and another 10%, it makes it a lot easier to compound over the long term. Um, yeah, so like I said, the as far I'll track the portfolio performance every at the end of every week and compare it to the S&P and the Nasdaq indices. And then, yeah, the two guiding principles is, first of all, to be the house, not the gambler, keep probability on my side. So as we saw, these strategies have a probability of success of above 80%. Um, so that's way better than half. And then the other principle is to sell time because time only goes forward. So this is the epitome of selling time, right? So Apple is trading at 250. So all of the value, all this $1,000 that someone gave me, is time premium. So even if Apple stays the same, or even if it goes down 10%, I'm going to be making all this profit. This option is going to expire worthless. What's it called? And that's the same for the Google position. Um, so these are two investment blocks. They're super, super conservative. And it may look or feel like this is boring to someone who's experienced or knows options or has already a portfolio. It's just a very, very small and simple portfolio right now. But like I said, my focus here is on capital preservation. And over the next weeks, I'll track the portfolio and adjust the portfolio when necessary and invest more into other companies or into these same companies, until I get full investment blocks. If you do wanna follow along, feel free to to sign up to get updates from my blog. Um, then that way, whenever I post, it'll go to you'll get an email about it. Um, and that's it. Thank you for joining this opening webinar of starting this portfolio. I'm very excited to follow it and see what happens. Um, I'm not too worried about short-term fluctuations in this price in this portfolio. It's like I said, it's a low touch. It's not a portfolio that you need to log in every day or every week even to see what's going on. Just to be aware of in the back of your mind that you have an investment rate and you want to add investments at a rate of whatever it is you decided. In our case, we decided around $12,000 every quarter. So you can look at, and that's about $4,000 a month. So if you've only invested 4,000, you should check in on it. You can check on it once. I'm going to check in on it at the end of every week just to track the performance. But really, once a month, twice a month is enough just to add some positions. Obviously, if you're more involved in the stock market and you're following it, if you see there was a down day, if there's a day that the market went down 2% or 4% or whatever, everyone's talking about the market going down and you're underinvested and you're growing your portfolio, that may be a sign that it would be a good day to add some positions, so to deploy some cash, especially when you're in a situation like us where basically the whole portfolio is cash and we're only set up to make $2,000 in over the next 2 years. So yeah, I mean, I want to aim for around $12,000 a quarter, but those $12,000 don't necessarily have to be $4,000 a month, and those $4,000 a month don't necessarily have to be exactly $1,000 a week. I am happy to take advantage of downturns. So if suddenly the market does go down 10% over the next month or two, I may decide to deploy slightly more than 4,000. And right now, on the opening day of the portfolio, I deployed already 5,500 of cash. So yeah, it's not, again, everything is flexible. Everything is guidelines. It depends on what you want to do. And it depends on the situation and the environment in the market. Um, but yeah, that's the goal. I'm going to sign off here. Feel free to check in on the blog and on the website and on the YouTube if you don't know about options or put options. I do one-on-one mentoring. You can read about the services that I do over here. But basically, my flagship service is one-on-one mentoring, where I hold your hand from the beginning, from wherever you are, even if it's at the very beginning. You don't have a brokerage account. You don't know what the stock market is. You don't know what investing is. I help you get set up from the very beginning till you feel comfortable making trades on your own, at however long that takes. Or also, if you already are investing and you want to adjust your portfolio and try to figure out, I don't know, maybe you're doing options, maybe you aren't, whatever you want, I'm here to do that service. And then, yeah, I just built this website relatively recently. I launched it not long ago. I have a FAQ about what kind of results I can expect, how much time will it require in a week or a month, how much money you need. Yeah, so feel free to check around the website, and yeah, and subscribe to the blog if you're interested in that. If you think they're if you think the content here could be interesting to you, and also you can also follow my social media. We got Instagram, we got Facebook, where I put out various content that could be feel free to give it a follow. As you can see, I'm just starting it. I got a long way to go, but you have to start somewhere, and this is where I'm starting. Yeah, so good luck to us, and I'll follow up on this in a week.